Yep, we're live now.
Just got to remember. That doesn't matter now.
Too funny. Okay, all right. So you're ready then over there?
Yeah.
I see you. I see the Bulls and Bears emblem.
Yes, that's unlocking that. So just make sure you're locking that.
Okay, perfect. All right, you want to start a hack 11:48? Just write down 11, or I guess I write down. All right, 11:48, and we're starting. All right, everyone, welcome to the class 1 for the introduction to technical analysis and day trading. I think we have everyone joined in and on board. First of all, I'd like to say thank you for coming on board with the Bulls and Bears team, and we look forward to spending the next week to 3 weeks with you, going through everything from our intro to day trading, technical analysis, and on to options and hedging. If you're with us for those 2 classes, if you're not and decide you want to, at the end of this course, obviously we can hook you up with that as well. All right, this is the first class, as said, for Bulls and Bears Intro to Day Trading and Technical Analysis. Everyone should have the PowerPoint up on their screen. You've got myself, Chris, as the primary instructor today, and then my partner Doug is on here as well. He's also a trader and instructor, and he's running backup behind the scenes for any technical issues or questions or anything else you may have. So you'll get a response from either Doug or I on anything going on. A quick familiarization of your screen. If you haven't used the this type of what is this called?
Webinar on Air.
Webinar. Google's Webinar on Air. On the left side of your screen, you should have the ability to what is the stuff that they have there? I had it up on my screen last time, but I don't have it up now. They can vote, they can raise their hand, which we're asking them not to do, and they can ask questions, right? Hang on, let me grab my pencil. Can you see it on yours?
Yeah, I see the you're seeing right
Oh, so you're not seeing the... Okay, so they have what they have... No, it's fine. I was trying to remember what it was. It's what? It's raise their hand, ask a question, poll. Okay, so you see on the left side of your screen there, if you kind of move your mouse around, you can raise your hand. We ask that instead of raising your hand, you just go ahead and ask a question. If you type that in, all questions will be simply between yourself and us. It will not be public for all those in the class. However, if you ask a question that we feel is pertinent to those in the class, we'll go ahead and read the question or share that and then answer it so everyone can benefit from that question. And then you also have a polling tab on the left side of your screen there. If we, from time to time, we may poll the audience to see things such as your trading experience and those kinds of items, and Doug will send those out, so you may see those. That'll pop up momentarily on the left side of your screen, but then it'll go away, so you kind of have to see it flash up there. Let's say every couple of seconds it'll go away. You got to click that, and then you can answer the poll question, and that'll be over there on the left side, like I said, left side of the screen. Hang on a minute while I get the enable Q&A set up from my end. So that should all be enabled now. All right. So first thing we have to do is congratulate all of you for being here. This is step one. All right. And I'm sure all of you, or most of you, have had some other experience in either trading or investing or whatever that brought you here today. As far as we're concerned, we'll start from the beginning, and this will be our step one in helping to either build or reinforce your foundation. So once again, congratulations for taking that step, for being here, and understand, and you'll hear me say this throughout the training, that training is a journey, it's not a destination. So your personal education and advancement and improvement will be continuous for as long as you're doing this. Ours certainly has been and will continue to be. So just understand that this class is meant to give you a starting foundation to build from, and whether you continue that on your own through more webinars and reading of books or classes or seminars or whatever, you want to go ahead and ensure that you do continue your education on for a more thorough knowledge of trading and investing. So welcome aboard, and congratulations. All right, for today's class, we'll do a quick introduction. We'll do a course overview. We'll talk about some basics in the market, different types of traders that are out there, and types of analysis. And if you have your guidebook handy, you can go ahead and pull that out, and you can follow along through that. The class, the book was written, and the class is structured right from that book, so the PowerPoints follow along. The PowerPoints will be simply kind of a bullet, broad-based information that we'll expand on with our experience here and with the backing of the book, and then we'll be able to answer any questions that you may have had as you read through that. You'll see a disclaimer in the front. We don't want to put that on the slide, but obviously we are not, maybe not obviously, but we are not a financial advisement service. We don't have a Series 7 or anything like that. We're traders. So if you want to consult your financial advisor or something before doing investing, that's just a standard disclaimer that we have to put in there. So that out there. As far as trading, it's not a hobby. So you can't look at trading as a hobby or something that's quick money. If it was, then everyone would do it. A lot of instructors we've had have equated it to being they're not equating it to being a surgeon or anything like that, but they use the analogy all the time of, you don't just go in and operate on somebody. It takes years and years of experience before you get good at that. Well, you don't just sit down at your computer desk and hit buy and sell and start making lots of money. Otherwise, everyone would do it. So you got to have a lot of time dedicated to this. You have to have patience inside of trading. You have to have a lot of energy and dedication and focus and a solid commitment to this to truly succeed. And more than anything, we say you have to have the desire. If your heart's just not quite in it, then you're out $49 or $99 at the most. So not a big deal there. Better to that'll be the least amount of money probably that anybody ever lost in this profession. But the desire has to be there, and the reason the desire has to be there is because that's what will drive everything else. All right, that time and that focus and that dedication and commitment, everything else comes from that. So it's not an easy profession, but it's a great profession if you can master it. As mentioned, there's follow-on courses available that we have or other people have. There's seminars out there in your local towns or cities. We recommend some books. There's books you can read, but just understand that that's all part of what comes after this introduction. Trading is a skill. It's a learned skill. It takes time to master it, and you must treat this as a profession. It doesn't matter if you're doing this part-time or full-time. If you have other jobs out there, I know most of you do, it doesn't mean that you can't do this. It just may mean your approach may go more towards swing trading or more to options trading than day trading, or you may day trade, a couple hours in the morning, a couple hours in the afternoon, one day a week, what have you. But you still have to dedicate time on those days that you're not trading to learning, to rehearsal, to researching, to perfecting your skill. It's a continuous development. The other thing that you need to understand in this environment and this type of profession is that unlike most other professions, you're going to be your own evaluator. So you have to be, from the very beginning, truthful and upfront and honest with yourself, because it's easy to pat yourself on the back when you do good, but it's not so easy to be hard on yourself when you do poorly. And then even harder than that, most people can go, yeah, I did a bad job at this, but it takes the ability to really look within yourself and to research and to remove kind of your view from your own self to go, why did I do poorly, or why did this not work? So not only evaluate that, hey, I may not have done well, but why didn't I do well, and how do I do well or improve in the future? So being your own evaluator is something that can be hard for people to manage. So that's something you have to keep in the back of your mind as well. All that being said, this course is a major step in the right direction, and will give you a solid foundation to go forward with. As far as a little bit about us, and I'll probably do this first or before I do the intro next time. I've been in the Marine Corps for 23 years, F-18 pilot and forward air controller. What's that have to do with trading? Kind of goes with the mindset of being well aware of systems knowledge and being able to analyze and think quickly and make decisions. And you'll see that like 99% of the time, any decision is better than no decision. So you got to make decisions, and you got to interpret data very, very quickly. So that translates over well from being a fighter pilot to being a trader. And then the other thing, and what we kind of tout as making this course different than other courses, and we don't get into it heavily in the intro because it is just an intro, but is the systems approach to training. And what that is you can't just jump into anything and expect to do well at it. I'm sure if you guys have read self-improvement books or mastery books out there, they'll talk about, in order to be very good at anything, it takes 10,000 hours of doing it to master it. And 10,000 hours of doing it correctly. 10,000 hours of doing something the wrong way won't do you a whole lot of good. But in order to get to those 10,000 hours, there needs to be some structure, some approach. And what the systems approach to training is it's approaching something in an academic manner, both in reading and in classwork, and then so you read it, you hear it, you see it, you say it, you go over that academically, and then you go into a practical application of that in a non-live environment, so whether that's through simulation or through a rehearsal, something there with an evaluation, an evaluator doing that. So it's a crawl, walk, run approach of academics, simulation, practical application, and then going live. And in trading, when you go live, you have to go live with a small account, and then or not a small account, but a small amount of money to see if you've traded or if you've perfected your craft, your trade, and then going live with a large amount of money. So it's that crawl, walk, run that will allow you to improve your skills and survive in this arena, which is, it chews up a lot of people and spits them out. You'll read anywhere between 5, maybe 10. 5 is the average. 5% of those who try truly succeed and can make this a career. So I don't say that to discourage you. I say that simply to let you know that it takes that dedication we spoke of earlier in order to make it and be one of those survivors. All right, the course overview. We hit a little bit just now on the systems approach to training, or we hit systems approach to training earlier in our intro on who we are. I guess I actually have this in the course overview. But yeah, that. All right. What's expected of you? I could almost add that onto the slide too. Introduction, course overview / our intro. What's expected? I'm just modifying the slide here real quick. I guess you can see that, or you'll see here in a minute. All right, so I got to go, when I do this outline slide, I just got to bust through it and then go right to the next slide, because then we go through each one of these. So, introduction, course overview, talk a little bit about us, what's expected of you, market basics, trade types, types of analysis, introduction, foundation, basic building block, mindset, journey versus destination. All right, that's the intro. Course overview, schedule, course flow. So in here, I'm going to go us, system for training. What's expected. Okay. Expected of you. All right, so what's expected of you throughout this course? Obviously, you're going to get out of it what you put into it, so we require you to do nothing. However, what we ask you to do, or what would behoove you the most to do, is to go ahead and read ahead prior to the classes to get an idea. That's that. Read it. All right. So you get the step of reading it and seeing it, and then when we say it and you hear it, that's another step. And then when you actually do it, so you're getting multiple ways of learning the material. So we ask you to read ahead prior to classes. If you have any questions, go ahead and look up that information and familiarize yourself with it a little bit. If you take a couple minutes to Google the information or the question you may have and see what you can read on it, one, that gives you the skills of where to kind of find some information for later on, and then two, it just gets it more ingrained in your head and allows you to see it one more or an additional time. The more times you see this, you're getting more towards those 10,000 hours of putting in effort on this material. So familiarize yourself with the online reference material. Absorb the information that we teach during the lessons. Ask any questions that you have. Post-lesson, do a quick review of what we just went over, so you're reinforcing what your brain just absorbed, or at least tried to absorb, and then do a quick look ahead of what's next. And then following course completion, like we've said a couple of times already, you need to continue your education and training prior to going live. However you may do that, we just you want to learn more, and you want to continue to learn more as you go forward. All right, on to the marks. Getting into some of the meat of what we're going to have in the intro class, or the first class here, is the market basics, or are the market basics. I'm sorry, I didn't get into the course overview. Course flow. Every day we'll be here 7:30 to 9:30 Central. We'll do 1 hour of class material, and we allow like up to an hour of Q&A. We'll see how that progresses. Class 2 is a chock full class, so if we get through a little early today, we'll move ahead. We won't have dead time. We'll simply just work ahead of the PowerPoints on to the next class and allow more time at the end for either some additional material or additional questions. Go ahead and read ahead, like we said, review the live material. And one thing that is a major part of homework that you really do have to do if you want to truly understand and be prepared for class is you need to get your system set up. And this is something that is a complete time requirement outside of the course. And the two things that are heavily, or the intense system setup, is going to be your charting and your platform. So no matter how good your knowledge is or how much you absorb what we talk about in class, if you don't go in and take the time to correctly set up your charts and master your charting and your scanning, which we'll talk about later, as well as go in and do your systems training on whatever brokerage firm you use, that platform, a trading platform, basically you'll be ineffective at trading. There's multiple webinars that you'll probably have to watch and information booklets you have to read on the platforms that you choose. And we'll recommend some for you, but make no mistake, that is a very time-intensive thing. Now, it's a one-time shot in the fact that once you do it, you've got it. So it's not like you have to continuously do that. But some of these platforms today are so capable, they'll do 90%. You'll use 10% of what they're capable of doing. So that is a homework thing that you'll have out there that you'll need to complete. Is once you choose your charting platform and your trading platform, is to spend a lot of time on their webinars and their how to use their platforms in order to be proficient. All right, market basics. There's 3 primary exchanges out there: the New York Stock Exchange, the American Stock Exchange, or Amex, and the NASDAQ. At the time that I wrote this, there's over 5,000 companies listed. There's probably more like 60, almost 6,500 now. There's an ebb and flow there as companies get delisted and get listed, and then kind of how the market's doing. You'll see whether or not there's a bunch of IPOs out there or not. As the market does better, and as the economy does better, you'll see a lot more IPOs. I'm sure recently you're familiar with GoDaddy, GoPro, and Alibaba. Those are 2 of the major IPOs that we just had, and there's quite a few companies that have IPOs. So there's been as many as 8,000 plus stocks to trade, and now there's, like I said, around 6,500. An easy way to do that, if you just look at FinViz, which we'll talk about later, the number of advancers and decliners, they combine the Amex, the NASDAQ, and the New York Stock Exchange, and they show you how many advancers there are for the day and decliners. You add those up, that's around 6,500. So that's an easy way to figure out how many stocks are out there for you to trade. Markets are open from 9:30 Eastern, and it won't matter if it's daylight savings or not, standard time, whatever. They're open from 9:30, whatever the time of the year we're in, 9:30 Eastern until 4 p.m. Eastern. Those are your standard market hours. And you may have heard or wondered about pre-market and after hours and all that. Pre-market trading goes from 4 in the morning until 9:30 in the morning, and then there's after hours trading from 4 p.m. until 8 p.m. So that's when you'll see trading take place outside of market hours. Trading volume is lighter, obviously, during pre- and post-market hours. So if you're trading during those times, 1, you have to be with a brokerage company that allows you to do that. 2, you need to be aware that liquidity is less during those times. So if you get into something, you can be in it, think you're doing well, and you can be up, whether you're long and it's moving up, or you're short, moving down. You sit pretty, thinking you're looking good, and then you can get a massive buyer come in or a massive seller come in and drive it way the other way, and in a heartbeat you could be down a lot more than you're ever up. So we recommend caution when trading pre or post market. However, you can definitely get in there and get ahead of the game if you know what you're doing. Futures are traded almost around the clock. The way they work is they'll start at 6 p.m. Eastern on a Sunday night. Futures will start trading, and they'll finish at 4:15 p.m. on a Friday. And why do we mention futures? Because they're obviously a way to get a good idea of what the you got to practice to be able to do this and watch Monday Night Football, Thursday Night Football. So futures are a good way to get an idea what the market's going to do. Don't put all your eggs in one basket there, though. Futures can easily reverse and go the other way on you. But so from 6 Eastern on Sunday till 4:15 on Friday, there are 2 breaks in that you'll see to kind of when they reset. They stop trading between 4:15 and 4:30, and that'd be obviously on Monday night, Tuesday night, Wednesday night, Thursday night. And from 5:30 to 6 Monday through Thursday, they stop trading. And those are during regular weeks, not taking into account holidays. Along with the primary markets we talked about, the NYSE, the Amex, and the NASDAQ, we have 3 primary indexes that go along with those that we'll talk about. That's the Dow Jones Industrial Average, the DJIA, Delta Juliet India Alpha, the NASDAQ Composite, COMP, Charlie Oscar Mike Papa, and the S&P 500, Sierra Papa X-Ray, as well as the Russell 2000, the Romeo Uniform Tango. So those are the primary indexes that we'll look at. Obviously, those are the ones you see on TV. The Dow's at 17,000, the Nasdaq's at 4,500, the S&P's at 2,000, et cetera, et cetera. And then, so the primary, and I'm not saying they're there now, those are just as examples, they're all around there. The primary ETFs, or exchange traded funds of those indexes that we'll reference a lot are the Dow Jones Industrial Average is Delta India Alpha, NASDAQ are the Qs, Quebec, Quebec, Quebec. S&P 500, Sierra Papa Yankee, and Russell 2000 is India, Whiskey, Mike. And so here's those referred to numerous times as the diamonds, spiders, and Qs. So diamonds are the Dow, DIA, Qs, NASDAQ, and then spiders, SPY. Russell 2000 doesn't get a little name for us, it's just IWM. All right. There are four major market cycles that occur. Oh, hang on. Give me a second here. There are four major market cycles that occur. And these are in your book, and we'll talk about these. Let me get a chart up for you. So what we're looking at here on the screen all right, Dirty, hang on. I've lost. Am I up? Are you seeing my S&P 500? Oh. I've completely lost. There we go. All right, so. Hang on. That is still live. Nice work. All right, hang on. I know what I'm doing here. I just got to get the fucking right screen up. No, it's not on yours. It's on mine, so I can see. All right, there we go. All right, perfect. Sorry, now I'm up. Okay, so we're on market cycles. There are four major market cycles that occur. For our purposes, we're going to go ahead and start as if the market's at the bottom. All right, as if the markets has just reached a low point in recent history. And what we'll give you to kind of give an example of this is we'll go ahead and go back to, and this is all jumbled up. But what you're looking at here is you're looking at a weekly chart of the S&P 500, the SPX. And we look back here in 2009 and we see a bottom. All right, so that's kind of what we'll show as a market cycle. And we'll talk kind of in depth here between 07 and 09, as well as 11 and 12. And then 12 to current. All right, the first cycle is the accumulation phase. And in the accumulation phase, remember we're talking about the market being at the bottom. So if you look back here in 09, there's obviously a bottom here. I'll zoom in a little for you. Sorry, it takes a little while for this thing to back up. Try and get you back to 2009 bottom. All right, each one of these are candlesticks. We'll talk about these in depth later, but each one of these sticks represents a week. So this is, 2, 4, 6, 8, 10, 12, 14, 16, 18, 20. Well, let's just look here. October to September, so almost a year where this bottom is kind of occurring. And it's the inverse head and shoulders, which we can kind of talk about later too. But what happens here is we get a bottom and there's accumulation going on. All right, you get a lot of selling. These red candles, red volume bars are selling, and you start seeing some accumulation. And the market's going up and it's going up and it's going up, and there's the volume starts to pick up and it starts to be a lot more green, and you see red in these volume bars, and the accumulation phase occurs. Moving averages we'll talk about later, but they start to flatten out. And what you'll get as an indication of the end of the accumulation phase is you'll see buy volume pick up, and you'll see moving averages flatten out and start to turn up. And once that happens, then you get out of the accumulation phase, and we'll go into the run-up phase. So in the accumulation phase, who's doing that? What's making this market do this? You know, is it the retail investor? No, what it is you get large investors like investment banks, retirement funds, etc., or the smart money. They start to enter the market here and accumulate equities in a manner that the downward price trend slows or stops. So this downward price trend we see has slowed in here, comes down, and it stops. And what do we see here? We now see a series of higher highs and a higher lows. And if you've seen a series of higher highs and higher lows, you're out of that downward trend for now. It's not saying it's gonna continue, so you don't know necessarily if you're in an accumulation phase here and the beginning of a run-up phase, or if you're simply in a secondary trend in that primary downtrend, which we'll talk about in a minute, and then the thing's gonna turn around again. So what we're waiting for, and like I said, we'll talk more later about moving averages, but these moving averages flatten out and start to turn up. All these moving averages, which we'll discuss later, they're going to flatten out and turn up. All right. So the volume picks up. All right. We don't really see a huge pickup in volume, but what we do see is in here the green candles are larger than the red candles for the most part, and that says that there's more buyers and sellers, indicating accumulation. Yeah, we got the prices are making, they're no longer making lower lows and lower highs, and begin consistently making higher highs and higher lows, which is what they're doing here. All right. Next phase is the run-up phase. All right. So you've got the accumulation phase, then the run-up phase, distribution phase, and the rundown phase. So the first cycle is accumulation. We discussed that. The run-up phase. During the run-up phase, you'll get retail and other investors that come in because they see the market starting to move. They see, just like you and I see right here, higher highs and higher lows, and they jump in. And as more and more money flows into the market from wherever it's been outside of the market, in cash, whatever, you'll see this lasting uptrend be established. And the moving averages will turn up, demand will exceed supply, and you'll get a solid run-up phase which could last for years. And we've seen that pretty much since this bottom in 2009. You've seen a pretty consistent run-up phase. I'll go ahead and scroll right here. It's going to take a little bit to move. Well, you see since the end of 2009 there, we've been in a pretty steady run-up phase. There's been a couple of pullbacks within that, which we'll talk about here in a second, and secondary trends. But overall, and you see my trend line drawings on there, but we've been in a steady run-up phase with a couple of secondary trends since 2009. All right, the distribution phase, which we're not in, and you can kind of look and see if I'll zoom in here, I'll back up some. All right, there was some concern in 11 and 12, right? So here, towards the end of 2011, we saw a sharp drop off. We saw some moving averages cross, which we'll talk about, and we saw some heavy volume selling pick up. They're really not even that heavy. If you compare this to 08 and 09, all right, we're looking at what, 10 million shares on that big volume sell day. That's this candle right here, 10 million shares being sold off. And we go back here to 08. So I can make this thing go any faster. It's kind of what we got to deal with here. Oh, you know what? I need to be on the SPY. Okay, let's look at 08 here on the SPY. 3 billion shares. All right, So heavy, heavy sell volume back here in this runoff, and lots of sell days, right? Lots of sell days in this pullback. Billions of shares trading hands. All right, now let's go forward to 11 and 12. Yeah, as soon as we're done, we're going to go. All right, we see right here in the end of 11, you see one day, 2.5 billion, gets heavy sales, but then it gets picked up. 200-day moving average stops it, and it runs up. And like I said, we'll address moving averages more later. But you're not seeing tons of distribution, so that would have been an indicator that, hey, this is not necessarily a distribution cycle followed by a rundown phase. There's just a secondary trend in the market. And then volume drops off back to normal again as we continue the run-up phase. So how are we going to know when this market that we're in now possibly ends and ends the run-up phase and goes into a distribution phase? What you're going to see is you're going to see the uptrend will slow, right? Which we had a time back here that we thought maybe in 14 that uptrend slowed. We saw a lot of sideways weeks here. We saw, a few months of sideways, but then it picked up again. So this is a potential area here where if we'd have seen a lot of volume come up here and seen a lot of distribution taking place, this could have been a distribution phase followed by a rundown phase. But hey, it consolidated, it went sideways, it rested, it wasn't really a distribution phase, and then as hindsight's 20/20 of course, but it picked right up. So what will be the indicators of a distribution phase? Once again, the uptrend will slow, prices will go sideways, moving averages will flatten out, and they'll begin to turn down or cross over. And like I said, we'll talk heavily about moving averages lately. What happens there? The smart money exits. You only get the retail and hopeful investors that are left buying the equities. The volume slows, moves higher, marked by weak internals, which we'll talk heavily about market internals. And then moving averages begin to point down. Supply will exceed demand, and then we'll go into a rundown phase. So that can also last for years until a bottom is reached. Then we sit at the bottom, accumulation phase is entered again, and then the cycle repeats itself. All this is Dow theory, and Dow theory can be researched heavily online or in numerous books if you have interest in full-on Dow theory. Okay, within the 4 phases of accumulation, run-up, distribution, and run-down, we have what are called primary and secondary trends. All right, so realize that a market is not just going to continuously run up or continuously run down. Within that, there's going to be time periods where there's either a pullback and a run up or a throwback and a run down. And we can go back to that 11 and 12 time frame now, where we had a bottom in 09, we had a solid run up from 11 to up to the end of 11. Hey, what are you doing?
Who's skipping?
It comes on. The cycle's through.
Yeah.
What it does?
No, all the best. I'd love to see them battle it out up and down the point. That's all right. It's your TV. Instead of watching the fucking rain.
Well, it's because the fucking Cowboys in Houston are probably at like the 50-yard line doing nothing.
What? Like, concentrate on your thing, man. That's more important than the website.
No,
I'm doing both. You're not even watching.
No, I'm listening to it.
doing
Because I practice. Monday Night Football and Thursday Night Football. I got to be able to do both. You know what the score is? You know what the score is in the game?
What's that?
0-0. Yeah, I'm listening to both. All right, so here, take it.
No. Yeah, no, you're back and forth. Seriously, man, concentrate on your shit, dude. I'm leaving that shit. It's not like I'm live. I think we get that. Yeah, here, so back and forth. That's nothing going on. But I do just hit last.
Yeah, just at last, yeah. that quarterback sucks. He should. There's no way.
I know. I can't believe the Texans always do plays.
Dude, that's the quarterback they go after. That defense they got, and they fucking go after him for the quarterback. It makes no sense. All right, so we see here we have a pretty steady run up from 9. Minor pullback here in 10, another run up, and then people started panicking here a little bit at the end of 11. And you see this nothing more than a secondary trend. So the primary trend is an uptrend. You have big volume come in for a couple days, but you have moving average support that runs in. You do have a crossover here, but you never have the 20 and 50-day crossover to 200. I'm talking a little bit of moving averages here. We'll get into that more later. But what you can see is some support comes in, which we'll address further later as well, and then the market continues right on. So there's no time period here. There's some sideways movement here. And there is, some distribution going on with these red candles here, but there's no major sell-off like we saw here, all right, where we just get massive panic, huge volume, repeated days of huge volume and sell-offs over these months here that really just drove the market down. No, we're already below support. We've come down from support up here in this distribution, and then the market just falls off. Whereas here in 11, market pulls down, it hangs out for a little bit here. There's some heavy volume, but not continued. Reference the volume back here, all right, compared to the volume here. I can give you a little bit of a, okay, hey, we might be okay, and then sure enough, it just turns right around, it goes back up. All right, so this is what would be a secondary trend and the primary uptrend. And you'll see these repeat throughout. We have a pullback in the summer here. If you look back, you can go, okay, hey, what was going on in those time periods? Is there geopolitical items going on? Is there economic items going on? We have the uncertainty with the, or not the uncertainty, but you had the election that took place in 12 there. You have, if you think back, we had the budget not being passed. That affected it. That was a temporary pullback. So you got to look in the context as well. You had the housing crash, obviously, in 08, right? You had a big catalyst to cause that the market crash. Here you have small catalysts that caused a secondary trend within the primary uptrend. All right, we could trade both of these. You can trade, take advantage of the market in the primary trend, take advantage of the secondary trend, and then it's just a matter of figuring out, hey, is this truly a secondary trend, or is it a new primary trend, or a market reversal? And no one knows for sure. We just use these volume and the moving averages as a way to give us an idea of what we think is going on. So secondary trend, and then here we are today. One way to figure out, like we talked about, is this a reversal in the market, or is it just a secondary trend? Is, hey, was there or was there not either a distribution phase if the market's been in a run-up, or an accumulation phase if the market's been in a rundown? And if there hasn't been that, then it's probably just a secondary trend. The beautiful thing about this is as a day trader, if that's what you're doing, you really don't care if it's a primary or secondary trend. We'll trade. You can make money either way. You just need to know what is the current trend. All right, whether the trend is up or the trend is down. Trade within that, and obviously there's a difference whether it's a long-term primary trend or a short-term trend on how long you stay in that. But either one of those are tradable. Realize that the most influence on the market will be the overall primary trend. That is the most influential trend on the market, the overall primary trend. Another thing to keep in mind is that 75%-ish, of course, 78% of stocks move with the market, regardless of how good our setup is, and we'll talk about setups later. But the saying goes, "A trend is your friend," and the rest of the saying goes, "A trend is your friend until it isn't." But the primary way we want to trade is with the trend to get the most moves. Another little key phrase or saying is that the market takes stair steps up and an elevator down. So we see that over time. I won't go back to 08 there, but it takes a long time for the market to go up, and then you see in a matter of a couple of weeks it can give back months of gains. So big, long, short moves up, and then quick, big moves down is the way the market tends to go. All right, we'll move away from the SPY there. Make sure we covered everything in our slide there, which we did, and move on to trader types. All right, there's three basic types of traders in the market. All right, as you see on the slide, there's position traders, swing traders, and day traders. And we'll talk about each one of those as well as the advantages and disadvantages of each. And also we'll talk about types of analysis after that. All right, position traders are typically referred to as investors. They employ a buy and hold technique, usually for months to years. They're looking to take advantage of the primary trend, usually in blue chip stocks, and they're looking to capture dividends. And they can either reinvest those dividends using dollar cost averaging, or just collect those dividends as a way to generate income, and they just buy and hold that stock and they have it forever. We won't talk a lot about position trading other than that in this class, as we address primarily day trading. Even swing trading we don't really get much into, but we'll give you a little information on that. Swing trading is like a 2 to 14 day type of trader. So what you're looking to do in swing trading is, you're not in the minutia. If you got a full-time job and you're not able to be behind your computer all day every day, but you want to take advantage of stocks that have momentum or stocks that may have explosive moves, you'll go ahead and this is the type of trader that you'll want to do, because you can get into a stock. You can take advantage of an explosive move, but you're not in there to be a loader. You're not in there to collect dividends. You may be looking to capture a big move during earnings season, a big move during a new product release, or something like that, or something that you're familiar with. You think it's going to make a jump. You look to get in and get out. A recent example of something like that would be TKMR, which is a pharmaceutical company that makes drugs that treat Ebola. That's the position that we took. Get in. Hey, there's an outbreak in Dallas. Not an outbreak. There's a case in Dallas, a case in D.C. All the investors are throwing, speculation money at that stock. It makes a big move. It makes a 300% move over a month. Get into that thing, hold it for a week or two. You get out. You can obviously day trade that too, but that's just an example of something that you're looking to capitalize on quick money above the stock. So that's swing trading. And then day trading is obviously, hey, we're in, we're out, same day. It may be anywhere from a matter of seconds to a matter of hours. We typically won't be in that, though, overnight. It's just a one-day trade. You can do a transition trade where you enter something as a day trade. Say you enter it around 3 Eastern. It makes a good move for you. You're able to take some profits. It starts flagging at the end of the day. We'll talk about flagging 5 times later. But it looks positive as a continued move the next day. So you get rid of some of your shares, you take a profit, you put a stop in at your break-even point for the remainder of the shares, and you hold that thing overnight, looking to capture and continue moving the next day. So those are your 3 different types of trading. The advantages and disadvantages of each. For position trading, you're going to go ahead and they're good for long-term, slow growth, and dividends. You can sell covered calls against those. If you go into our options class, we'll talk about covered calls and how that can generate income along with dividends. It's a good way to do those on the position trading. You can capitalize on long-term large gains over long-term. And your big-time money managers, they're position traders. They put their money in stocks that are going to do well over time, and then they just let it sit and grow. The drawbacks for that, the per-trade gains are larger, but overall gains can be less than in a day. Your percentage got less, and your capital is tied up for a long period of times, obviously, if you're in that. And you got to get your picks right. You got to be a solid stock picker, or you risk constantly getting stopped out in and out. one of those stocks for long-term capitalizing on those gains. For swing trading, the benefits of swing trading is you can still get a large gain over a few days. You don't have to micromanage the trade every day on those intraday charts. You can do this with a full-time job, and you're not going to burn up a lot of commissions like you would in day trading. Drawbacks, in a choppy market, you're going to get stopped out, so it's more difficult to make gains in a choppy market. The effects of news are really going to move those stocks around more than what it would. You're not going to get too wrapped up about it in position trading, but in swing trading, you can get chopped out. News can really affect your stock, and you can be in and out before you have a chance to capitalize any gains. You're not really going to generate consistent daily income. It's less likely. You might generate weekly or bi-weekly income doing swing trading. You do have exposure to overnight risks, such as gaps in the price of the underlying. You have risks of what could happen to the stock after hours, pre-market. If there's a bad earnings report, if there's issues with the FDA, if you're in the bio stocks, biotech stocks, a lot of things happen there where they'll gap up or gap down. Stops won't be effective, and you have exposure and more risk after hours if you're doing swing trading. But that's just a known issue. It's not necessarily a reason not to do it. You just have to be aware of that. Your capital could be a less efficient use of your capital if you're tied up in swing trading stocks. You have to wait for something to happen for those 2 to 14 days by being in and out in the same day and on to your next trade. It does require a lot of discipline. You must get a very good entry, and you have to sit and wait for let the trade develops, and you have to obviously have valid setups, but that's kind of the same with day trading as well. So that's swing trading. As far as day trading, the benefits of that, you're in or out. All right, you know what your risk is on your entry. You're in it, and it either works or it doesn't. You're on your next trade. Risk mitigation is easy. Once again, you know your stop before you enter. You know your target price, so it's easier to mitigate your risk, and it's easy to understand or know if it's working out right away. You capitalize on short-term movements. You're there for a stock that has a catalyst, and you think it's going to move. You're able to do that thing, and then see if it moves or not, and then once again, you're in or out, which gives you efficient use of capital and allows you to capitalize on short-term movements. Drawbacks of day trading, obviously you have a full-time job. It can be difficult. It requires real-time data and charting, which depending on your service, it costs you money. But most brokerages these days, you should be able to be in a brokerage firm that does not charge for that data. But you have to be efficient with that charting and that data and have all your systems set up and able to use that. There is a pattern day trade rules, all right, and you are restricted by those, which could affect some of you depending on your account size. If you have and you can look this up online, we're not financial advisors here, but if you have an account with under $25,000 in it, you're not allowed to conduct multiple day trades. I forget what the rule is exactly, but it's something in 3 or 4 trades a week. What that means is buying a stock and selling a stock, buying a stock, selling a stock, buying a stock, selling a stock. That is 3 round trips or 3 in and outs. And if you do that, it's either 3 or 4 within a 1 week period. That's all you can do. So obviously, if you have under $25,000 in an account, it's difficult to day trade because you're only going to be able to do 3 or 4 trades a week, and then you can reset and do it again the following week. Now, there are some ways around that by being running a prop account or prop firm and trading with them. That's something we can talk to you offline about. If that's something that you think you'd like to do, you can do that with, we recommend a minimum of $5,000. You can go in, throw your money into a pool. Your money is your money. But you're able to avoid the day trading rules and trade as if you had a $100,000 account. Usually those, you're on a 10-to-1 margin, whereas a standard brokerage account is usually 4-to-1. If you have $25,000, you can trade like you have $100,000. because you're in and out of those trades, you're not holding overnight, so it gives you more buying power. You don't have overnight buying power, you have a 4-to-1 buying power for short-term trades. Some companies, you gotta be careful, they will give you 4-to-1 overnight, but if you are margin, then they'll charge you interest on your margin. So you want to look into that. If you're with a prop firm, you're usually going to get 10-to-1 buying power. So if you have $5,000 in an account, you get $50,000. $10,000, you get $100,000. So you get that same buying power with less money and avoid day trade rules. But you're going to get hit other ways, commissions, other stuff. But they always get you one way or another. But there's a will, there's a way in today's environment to go ahead and day trade. All right. Last thing for today, we'll talk about types of analysis real quick. Fundamental analysis, which is what we do not do here at Bulls and Bears, is it's a deep dive into the financials of a company. You're researching it's quantitative analysis. You're looking at the company's revenue. You're looking at their expense sheets. You're looking at their assets versus their liabilities, and all the other financial aspects of their company. What is their cash on hand? What is their products development? What is their, what are they doing next? What are they going to do to generate money for you that you think that their, PE ratio is off, or their value is going to go up, and they're undervalued currently, so you're going to buy them now while they're undervalued and capture that gain in value. All right. That's fundamental analysis. You're gaining insight on a company's existence today and predicting yourself their future performance. You're going to spend a lot of time looking at their balance sheet, their income statement, cash flow statement, how they all fit together, and figure out where they're going to go for you. And that's typical if you're going to just be a buy and hold investor and you're out there and you're with Everett Jones or A.J. Evers or whoever else, and you've got a financial advisor. He's telling you that's what he's found out. He's doing that stuff, and he's saying, hey, I think you should buy X, Y, Z. And you go, okay, you put your money in, and then he takes a cut for doing that. He's getting paid to be a financial advisor and do fundamental analysis. Now, he's not doing fundamental analysis. Their company's doing it, and he's pushing whatever the company is saying, hey, these are fundamentally sound companies. We recommend you guys do this or do that. You get guys sitting at the desk talking, he's not doing that. He should be if he's working in the building. He's not. Now, technical analysis. We like technical analysis because guess what? We control it. It's black and white. It's fact. These are the numbers. This is information, and it's over to you to do what you think best with it. Okay. So technical analysis involves evaluating securities by looking at statistics generated by market activity, such as past prices and volume. All right. We do not attempt to measure a security's intrinsic value. We use charts and other tools to identify patterns that can suggest future activity. We believe that the historical performance of the stocks in the market are indicators of future performance. We use technical analysis with a catalyst, or a spark, if you will, to ensure an equity is in play or a mover and it meets our requirements, and then we go ahead and trade that. And the most important part of technical analysis is past price and volume. Volume supports price. Price is what it is. Price is your true indicator of what is supply and demand on that underlying, and then volume gives you, like volumes is, hey, I'm a true believer or not. Solid volume behind a move and a price is an indicator that, hey, there's something with this. Not so solid volume behind a move and a price, we don't know what's really going on with that. It doesn't have the oomph behind it that we think we might need. So we'll get into that in a lot of detail in the next class. All right, everyone, today we did an intro of ourselves and the class. We talked about market basics, what markets are out there, some of the indexes and ETFs of those markets, when they're open, etc. We talked about the cycles of the market, and we talked about the trends of the market. We talked about the traders that are out there and the analysis that's out there. Tomorrow, we're going to go heavy into terminology. Within the market itself, within trading the market and the indicators of the market. Don't worry today if you didn't understand some of the moving averages and volume that we talked about. We'll talk about that a lot tomorrow. But if you go ahead and do your read ahead for tomorrow, that'll help you out in preparing for the terminology aspect, which if you don't understand your systems, you don't understand your terminology, then you can't be an effective trader. So all this goes into the foundation of being a successful trader within the marketplace. Any questions? All right, you good, Dirty? That's exact 59 minutes.